What's up, guys? It's your boy Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Zillow, ticker symbol ZG, trading for $60.50 as of June 20th, 2020, equating to a market cap of $13.5 billion. It's been a crazy ride for Zillow investors. As we can see here, in the last 3 months, Zillow's share price has made over a 157% rally, once again about to test the $65 ceiling that the company has failed to break through multiple times. So what's the move? Are we buying the keys to Zillow or leaving the for sale sign in the yard? This is your quick stock analysis. For transparency's sake, we actually have a small position in Zillow of $1,750, representing nearly a 75% profit, which certainly isn't bad for one of our relatively new positions. As always, before investing in a company, I think it's important to see how a company projects itself. According to Zillow's official website, they are the leading real estate and rental marketplace dedicated to empowering consumers with data, inspiration, and knowledge around the place they call home. That's great and all, but how does the company make money? As users can take advantage of Zillow's tools for free, and in many ways, Zillow's platform is just a middleman. Well, it's kind of interesting. Zillow states that it's actually a media company that generates a majority of its revenue by selling advertisements on its website. Simply put, Zillow monetizes search traffic with ad revenue from third-party services, such as home builds, remodels, mortgage lenders, and so on. But you gotta admit, it's kind of crazy to think that the leading real estate and rental marketplace makes a majority of its revenue from selling advertisements. Now that we understand what Zillow is, let's get into some numbers. As of March 31st, 2020, Zillow reported they had $2.6 billion in cash on hand, which was a 26.4% increase year over year. Even after its historic rally, it's pretty impressive a company with a $13 billion market cap has $2.6 billion in cash on hand, which is actually kind of interesting, as the company easily has enough cash and short-term investments to cover all of Zillow's debt, which is around $2.2 billion, with 1.7 of that being long-term debt. And I should quickly note, their debt definitely isn't going into foreclosure. When we take a look, $563 million of Zillow's debt is asset-backed debt. In other words, Zillow owns the home as debt, so more accurately, Zillow holds about $1.6 billion of corporate debt that matures at various times over the next 6 years. Even more interesting, for a majority of Zillow's debt, it can settle it in either cash or stock. So if things were to get bad enough, Zillow can settle its maturities in its own stock. So just to make this crystal clear, $563 million of Zillow's debt is in the form of homes that they own and receive mortgage payments towards, which are actually currently valued at around $630 million. And roughly, the remaining $1.6 billion can be settled in the company's stock options. So financially speaking, the company's foundation has been built fairly sturdy. However, after the company's last earnings call, Zillow's group filed a prospectus seeking a secondary public offering of $1 billion in stock and convertible notes, which at the time resulted in quite the drop in share price, clearly turning out to be just a drop in the bucket as share price has skyrocketed since. It's just interesting that a company with so much cash on hand or in liquid assets felt the need to have a secondary public offering. I'll spare you from my speculation as I trust the CEO, Richard Barton. Anyways, I'm sure some of y'all are thinking, how does a third-party realtor become a multi-billion-dollar company? Well, to be frank, the website has become many homeowners' go-to website when it comes to buying and selling homes, as they offer users a wide variety of tools. The company reported they had 36 million unique visitors during January 2020, and 4 out of 5 homes in the United States have been viewed on Zillow, which is pretty insane to think about. Let's quickly take a look at some of the companies under Zillow's umbrella. I'll spare you from a majority of them, as you can imagine, they're all relatively similar. Trulia, which works similar to Zillow, is a real estate marketplace where interested buyers and renters can search their database of homes in a given area. Trulia gives in-depth neighborhood reviews that provide buyers with information about school districts, crime, and walkability of a given area. HotPads, which serves renters who are looking for a new apartment or house. The search platform was founded in 2005 and acquired by Zillow in 2012. It is a part of Zillow's rental network and generates income by using the same model that Zillow does. Realestate.com. As another member of Zillow's rental network, Realestate.com is a real estate marketplace in which first-time home buyers can search for and find homes that suit their needs. So with all of this in mind, what's the move? Well, let's be real, Zillow is a boss company that has a really strong brand name. And let's be real, when most people go to buy or sell a home, they're going to start online, and very likely on Zillow. The idea you can get a Zestimate of your house price and get it listed and sold with very little effort, at least in comparison to traditional real estate, is extremely appealing and changing the game. However, technically Zillow isn't showing a profit on accounting, although they are cash flow positive, and that's definitely worth noting. In other words, Zillow is self-financing its other projects. They're taking the cash flow from their advertising business to help get their home buying business off the ground. For our quick stock long-term portfolio, remember we started our position for the $34 range. It would be really hard for me to nearly double our cost basis. However, what we briefly mentioned earlier, Zillow has had a hard ceiling of $65. If the company can break and hold that range, it has plenty of room to run. Remember, this company currently only has a $13 billion market cap, which, don't get me wrong, is a lot. But really, if you consider the market they are playing in, if they play their cards right and the economy can remain stable, I wouldn't be surprised to see the company double its share price relatively quickly. And a decade from now, I think people will be blown away thinking back to a time when Zillow was only a $13 billion company. However, just to note, twice after testing its $65 ceiling and failing, the company was followed by a 50% decrease in share price. Take it for what it is. With this in mind, as a long-term investor, I definitely think Zillow is still a buy. However, there is some risk, and I would recommend investors doing dollar cost averaging to protect themselves from potential volatility. Anyways, guys, that's all we've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 505 subscribers and plan an early retirement. I'll catch you guys in the next one.